Most people hear the word stocks and immediately feel confused, distant, or even slightly anxious because the topic often sounds complex, risky, or reserved for experts, even though stocks are deeply connected to everyday money decisions in modern economic life. Many people think stocks are only for rich individuals, financial professionals, or people who enjoy watching numbers move on screens. But this belief hides a much simpler reality that affects almost everyone, even those who never plan to invest. To understand stocks clearly, you do not need advanced mathematics, secret strategies, or special knowledge, because at its core, the idea of stocks is surprisingly simple and closely linked to how companies grow and operate. When a company wants to grow beyond its initial resources, it often needs more money to expand, hire people, develop products, or enter new markets. And this is where the concept of stocks begins to matter. Instead of borrowing all the money from banks, a company can choose to divide itself into small parts, allowing other people to own a piece of the business in exchange for providing capital. Each of these small parts is called a stock, and owning a stock means you own a small portion of that company, even if that portion is very small compared to the entire business. This ownership does not usually involve daily decisions or management responsibilities, but it does connect your financial outcome to how well the company performs over time. If the company grows, becomes more efficient, or increases its influence, the value of its stocks may change, reflecting how the market views the company's future and stability. It is important to understand that stocks are not physical objects you can hold, but financial representations of ownership that exist within systems designed to track and manage these shares. Historically, stocks were created to allow businesses to grow faster than individual founders could manage alone, spreading both opportunity and responsibility among many participants. Because of this structure, stocks became a central tool in modern economies, connecting individual savings to corporate growth in ways that shape industries and innovation. However, stocks are often misunderstood because people focus only on short-term price movements rather than the underlying purpose of ownership and participation in business activity. When you buy a stock, you are not simply betting on numbers going up or down, but taking part in a system where companies and individuals share both success and uncertainty. This is why learning what stocks are is less about predicting outcomes and more about understanding how financial systems connect people, businesses, and long-term planning. Stocks also reflect human behavior because prices move based on expectations, emotions, confidence, and collective decision-making rather than purely logical calculations. This psychological dimension explains why stock markets can feel unpredictable, even when the companies behind them operate with clear structures and measurable performance. Understanding stocks helps people develop healthier financial habits, because it encourages patience, critical thinking, and awareness of how decisions made today influenced future outcomes. Without this understanding, many people either avoid stocks completely or approach them emotionally, reacting to fear or excitement instead of thoughtful evaluation. Avoiding stocks out of fear does not remove their influence, because stock markets still affect pensions, retirement systems, employment stability, and broader economic conditions. This means that even if you never buy a stock directly, stocks still shape your financial environment in indirect but meaningful ways. Learning about stocks is therefore not about becoming an investor immediately, but about building financial literacy that improves how you view money and risk. When people understand stocks properly, they begin to see them as tools rather than threats, and as long-term concepts rather than daily distractions. This perspective shift is essential because financial decisions made with understanding tend to be calmer, more consistent, and better aligned with personal goals. At this point, it becomes clear that stocks are not mysterious or reserved for a small group, but are part of a broader system that anyone can learn to understand. To move forward, it is important to understand where stocks are actually bought and sold, because this process does not happen randomly, but inside organized environments known as stock markets. Stock markets exist to connect people who want to buy ownership in companies with those who want to sell it, creating a structured space where prices are formed through collective decisions, These markets operate during specific hours and follow clear rules, helping ensure transparency, order, and fairness in how stocks are traded between participants. The price of a stock changes when people's expectations about a company change, often influenced by business performance, economic conditions, and future outlook rather than present reality alone. When many people believe a company will perform well in the future, demand for its stock can increase, which may push prices higher over time. On the other hand, when confidence weakens or uncertainty grows, people may become more cautious, leading to reduced demand and lower prices. This movement is not controlled by one person or institution, but by the combined behavior of thousands or millions of individuals making decisions simultaneously. Because of this, stock prices reflect not only facts, but also emotions, assumptions, and shared narratives about what the future might look like. This is why short-term price movements can feel confusing, even when a company's core business remains relatively stable. Understanding this dynamic helps reduce emotional reactions, because it shifts focus away from daily fluctuations and toward long-term business fundamentals. Stocks are often described as risky, but risk is closely tied to time horizon and behavior rather than the concept of stocks themselves. Short-term thinking increases uncertainty, while long-term thinking allows temporary changes to smooth out as businesses grow, adapt, or sometimes fail. This does not mean that all stocks are safe, but that understanding risk requires patience, perspective, and realistic expectations. Another common misunderstanding is believing that owning stocks means constant monitoring and frequent decision-making. In reality, many people approach stocks as part of a broader financial plan, reviewing decisions occasionally rather than reacting to every market movement. This calmer approach supports healthier financial habits, reducing stress and preventing impulsive choices driven by fear or excitement. Stocks also teach an important lesson about responsibility, because ownership connects outcomes to real-world performance rather than abstract ideas. When a company succeeds, it often reflects years of effort, innovation, and discipline, and stocks act as a bridge between that effort and individual participation. When a company struggles, it highlights the reality that growth is never guaranteed, reinforcing the importance of diversification and thoughtful decision-making. Understanding stocks also improves how people view money itself, shifting focus from consumption to allocation and from short-term pleasure to long-term value. This shift encourages individuals to ask better questions about where their money goes and what role it plays in their future stability. Many financial mistakes happen not because people lack intelligence, but because they lack clarity about how systems like stocks actually work. Education reduces fear, and reduced fear leads to better financial decisions made with intention rather than reaction. At this stage, it becomes clear that stocks are not about predicting outcomes, but about participating responsibly in economic growth. This participation does not require perfection, but it does require understanding, patience, and respect for uncertainty. Stocks reward consistency more often than excitement, and discipline more often than boldness. By viewing stocks as long-term instruments rather than quick opportunities, people align their actions with sustainable financial habits. This mindset helps separate speculation from education and impulse from strategy. As understanding deepens, stocks begin to feel less intimidating and more like one of many tools available in personal finance. This is where confidence grows, not from control over outcomes, but from clarity about how decisions connect to time and behavior. With this foundation, it becomes easier to continue learning without pressure or unrealistic expectations. As people continue learning about stocks, they often realize that the subject is less about markets and more about mindset, because financial understanding changes how decisions are made in many areas of life. Stocks encourage delayed gratification, since meaningful results usually come from patience and consistency rather than quick reactions or emotional choices. This lesson extends beyond investing, influencing how people approach saving money, planning goals, and evaluating trade-offs in everyday financial decisions. When someone understands stocks, they begin to see money as a tool that can be allocated intentionally instead of something that is only spent or feared. This awareness creates distance from impulsive behavior, helping individuals pause before acting and consider long-term consequences rather than short-term emotions. Stocks also highlight the importance of learning before acting, because informed decisions tend to feel calmer and more controlled, even when outcomes remain uncertain. This calm approach is essential in personal finance, where stress and anxiety often come from misunderstanding rather than from the situation itself. Understanding stocks does not remove risk, but it replaces confusion with clarity, which is often the most valuable shift in financial thinking. As clarity grows, people stop viewing financial topics as intimidating and begin seeing them as skills that can be learned gradually over time. This gradual learning process reduces pressure and allows individuals to build confidence naturally, without unrealistic expectations or urgency. Stocks also remind us that progress is rarely linear, since both businesses and individuals experience periods of growth, stagnation, and adjustment. Recognizing this pattern helps people stay committed to their plans instead of abandoning them during moments of uncertainty or doubt. Financial maturity develops when people accept that uncertainty is part of every meaningful decision, not something that can be fully eliminated. Stocks reflect this reality clearly, showing how long-term participation often matters more than perfect timing or constant activity. This perspective encourages responsibility, because outcomes become connected to choices made consistently rather than to isolated moments. When people internalize this lesson, they become less reactive and more intentional with their financial behavior overall. Understanding stocks is therefore not about becoming someone else, but about becoming more aware of how money systems interact with personal values. This awareness helps align financial actions with life priorities, reducing internal conflict and improving decision-making confidence. Over time, this alignment supports healthier habits, clearer goals, and a more stable relationship with money itself. At this point, stocks are no longer just a concept, but a lens through which financial choices can be evaluated more thoughtfully. This does not mean constant involvement or complexity, but rather a steady understanding that guides behavior quietly in the background. Financial knowledge works best when it simplifies thinking, and stocks, when understood properly, do exactly that. They turn abstract ideas into understandable systems, making money feel less overwhelming and more manageable. As the topic comes to a close, it is important to remember that learning about stocks is a process, not a destination. There is no need to rush, compare, or pressure yourself, because understanding grows naturally with curiosity and patience. What matters most is building a foundation that supports thoughtful decisions over time. Stocks are simply one part of that foundation, offering lessons that extend far beyond markets. With clarity, patience, and realistic expectations, financial confidence becomes a byproduct rather than a goal. This quiet confidence is often what leads to better choices and long-term stability. And as you continue learning, remember that understanding money is not about control, but about awareness and intention. That awareness is where meaningful financial growth truly begins.